Welcome to this video on the option Greeks. This is going to be a very important video. The option Greeks are essential to know because they're going to tell you how your option is going to perform under different market conditions. An option is going to behave differently 30 days out until expiration than one that's expiring this week. So you can think of the option Greeks as your navigational tools in the financial marketplace. They're going to let you know what behavior you can expect from your option. Now, I've talked a lot about the factors that determine the price of options. We know that option prices change when a stock moves up or down, and that every day a little bit of the premium erodes due to time decay. But by how much is it changing and how quickly and how soon? That's what the option Greeks measure. The option Greeks show us how sensitive our option premium is to changes in the factors that determine option prices. Understanding the option Greeks is essential because it's what allows you to predict how your trades are going to perform. So there are four main Greeks: delta, gamma, theta, and vega. I'm going to start with delta because it's often referred to as the king of the Greeks because it's the most impactful of all of the four Greeks. Delta measures how much the option premium changes for every $1 move in the underlying stock price. So let's say we have a call option right here. The premium is $3 and it has a delta of 0.55. Now, let's say that the stock moves up $1. The premium is going to change to 3.55. What you would do is you would add the premium and the delta together. So if it moves up $1, congratulations, you've just made $55. On the other hand, if the stock moves down $1, your premium would decrease to 2.45, and you get that by subtracting delta from the premium. So the value of your option is decreasing. On the other hand, let's say we have this put option. The premium is 2.75. The delta is negative 0.25. Now for put options, delta is always going to be negative because the profit is going in the other direction. So the negative sign, that's what that represents. So if the stock moves up $1, the premium is going down because the put option is losing money. It would go down by the amount of delta. So 2.75 minus 0.25, and the premium is $2.50. On the other hand, if the stock goes down by $1, the premium would increase to $3. You'd have 2.75 plus the delta of 0.25. And that makes sense because put options make money when the stock goes down. Some important points about delta: call options have a positive delta and put options have a negative delta. You can also use delta to determine the moneyness and the probability of success of the option. So in the money options have a delta of 0.51 to 1. At the money options have a delta of 0.5. And out of the money options have a delta of 0 to 0.49. So in the previous example, this call option would be in the money because the delta is 0.55. And this put option would be out of the money because the delta is 0.25. One of the coolest features about delta is that you can use it as a proxy to determine what the probability of success for that option will be. So an option with a delta of 0.4 can be seen as having a 40% chance of expiring in the money. So the last thing I want to say about delta is that it does not move at a constant rate. the amount by which delta is increasing your premium is going to be changing. And so that change is measured by gamma. Gamma is a derivative of delta, and it's the second derivative of price. Gamma measures how much delta moves for every $1 move in the stock. So let's say that we have a stock trading at $50. We purchase a call option. The premium is $3. The delta is 0.25, and the gamma is 0.02. Let's say the next day that the stock price moves up $1. The premium is going to increase to 3.25 because we're adding 3 plus the delta of 0.25. The delta is going to increase as well to 0.27. And what we're doing is we're adding delta and gamma together, and we get this new delta of 0.27. And the gamma has now increased to 0.04. The next day, let's say the stock goes up $1 again. The premium is going to increase to 3.52 because we're adding 325 plus 0.27. The delta increases to 0.31 because we're adding the delta of 0.27 plus the gamma of 0.04. And then gamma is going to stay the same in this example of 0.04. So for gamma, you're basically adding it to delta, and that's the amount that it's changing. So as you can see, as the stock price goes up, the premium is changing by a greater amount than it did the previous $1 move in stock price. So the main point of gamma is to tell you whether or not your option is getting more or less sensitive to changes in the stock price. Gamma is largest when an option is at the money and close to expiration. This is where changes in the stock price lead to huge swings in the premium. And the reason for this is because the option is straddling the line between in the money and out of the money. It's neither here nor there. It's either worth something or it's going to expire with some value. So when an option is close to expiration and it's at the money, the value of that option is going to start swinging wildly because the option is either going to finish in the money or out of the money. There's no in between. There's no gray zone. It's either going to expire worthless or it's going to be expiring with some value. The next Greek is theta. Theta measures how much value an option loses every day. This is basically the amount of time decay your option position will experience. So for long positions, theta is always negative, and for short positions, theta is always positive. Let's say that we have an option here. It doesn't matter, call or put. The premium is $3, and the theta is negative 0.05. So if our starting premium is $3, and in this example, let's just say that the stock price remains the same, implied volatility remains the same, every other factor doesn't change except for the amount of time that passes. Every day, your option premium would decrease by 5 cents. That is theta working against your position. So just know that every day that passes, a little chunk of your option premium will be eroded. Theta accelerates the closer the option gets to expiration. So an option with 60 days until expiry will have very little time decay, and an option with 15 days until expiration begins to lose value very rapidly. So this is something important to keep in mind when you're looking at buying options. Options with closer expiration dates may be enticing because they're cheaper. You don't have to pay as much for them, but just know that you need the stock to move in your favor very quickly because you're losing larger and larger amounts of the option premium due to time decay. So that's something to keep in mind. Another very important point, time decay is the reason you short options. What you are doing is you are selling a valuable option, waiting for time to erode the value, and then you're buying it back at a cheaper price. The money the option buyer loses from time decay is the option seller's profit. And this is important. There are entire option strategies where the only goal is to profit from time decay, not movements in stock price. This is how people make money when a stock goes sideways or does nothing at all. People are basically constructing trades where the trades are a net credit, meaning you're selling options. And so what people do is they just kind of sit back and they kind of collect the time decay that the option buyer is losing on his position. And we'll go over some of those strategies in later videos. The next Greek and the last one is Vega. Vega measures how much an option price will change due to a 1% increase in implied volatility. An option with a Vega of 0.02 means that for every 1% increase in implied volatility, the option premium increases by 0.02. So you might remember me saying that implied volatility inflates the value of options and lowering implied volatility deflates the value of options. Well, Vega shows you exactly by how much your option premium is increasing and decreasing. So looking at a stock's implied volatility can help you determine which strategy to use. When volatility is high, many traders will prefer to sell options because the premium has been inflated by a high Vega and then profit when volatility drops. When volatility is really high on a stock, it might not be the best idea to buy an option, because if you're buying an option when volatility is really high and then the volatility drops, it's going to crush the value of your option. Even if the stock moves in your favor, the volatility drop could be so big that it could wipe out any move in delta that your option premium would experience. And if you're talking to experienced traders or looking at a forum, people will often refer to this as an IV crush or implied volatility crush. So it's important to keep in mind if you read things about high implied volatility for a stock. When the stock or the markets go down, volatility usually increases because selling stock implies that the stock has become more risky. So things that cause spikes in implied volatility are earnings announcements, and that's because nobody knows how a company will perform. So remember, implied volatility is just how much the market thinks the stock is going to move. And so because earnings announcements are an uncertainty, nobody knows how it's going to do, implied volatility is more because nobody knows if the stock will shoot up or shoot down or do nothing at all. So option prices become very, very expensive the week before earnings announcements. And then after they're announced, implied volatility crashes because now there's certainty. People know how this company performed. So things that cause uncertainty in the markets cause implied volatility to spike. The longer an option has until expiration, the higher its Vega is going to be. This means that an option with lots of time left is going to react more to changes in implied volatility than options expiring sooner. So if you have an option with 90 days out, it's going to be more sensitive to changes in volatility because there's more time for the stock to make bigger moves. So naturally, the implied volatility is higher. So now let's put all four of the Greeks together. Let's assume in this example that the stock is moving up in $1 increments. I know that that's not realistic, but this is just an example, and I just want to get the point across. So let's say that this is a call option. The premium is 250, the delta is 0.30, gamma is 0.03, and the theta is negative 0.05, and vega is 0.02. Let's say that the stock moves up $1. The premium will change from 250. We add the delta of 0.30, and we subtract theta because a day has passed. So our new premium is $2.75. Now our call option has a new set of Greeks. The new delta is 0.33. The gamma is 0.04. Theta is negative 0.05, and vega remains at 0.02. Now let's say the next day the stock goes up another $1. Our previous premium of $2.75 is going to go up by 0.33. Another day has passed, so another 5 cents is lost due to time decay. And implied volatility has decreased by 1%. So vega is going to go down by 2 cents. Our new premium is 3.01. So our new call option has a premium of 3.01. The delta is 0.37, and we get that by adding delta and gamma together. The gamma stays at 0.04. Theta has increased to negative 0.06, so it's beginning to increase. And vega stays the same at 0.02. So I hope that example makes it clear how the option Greeks work together. In trading platforms, all of this is calculated for you, and usually it shows you in dollars what the Greeks are going, how the Greeks are going to impact your profit and loss. So the Greeks are very important, especially when you start constructing trades with more than one option. They're important to know for single options, but they become even more important when you're constructing strategies that use 2 options, 4 options, sometimes 6 or 8 different options. So the Greeks are a very, very good way to kind of navigate your position and see how it's going to react. So in the next video, I'm going to go into Thinkorswim and show you the Greeks in real time and how they're moving for a position.